Before we begin, a quick and important disclaimer. The content provided in this masterclass is strictly for educational and entertainment purposes only and does not constitute professional, legal, financial, tax, or investment advice. Navigating a divorce, particularly one involving complex financial instruments, retirement accounts, and state-specific marital property laws, is highly intricate and deeply individualized. The information discussed here, including the mechanics of asset division, tax implications, and regulatory frameworks, is broad and generalized. I am not a financial advisor, a certified public accountant, or an attorney. Every viewer must conduct their own extensive due diligence and consult with licensed professionals, such as a family law attorney, a certified divorce financial analyst, and a tax professional, who are legally bound to consider the specific nuances of your personal situation and jurisdiction. Any discussion of historical trends, potential outcomes, or hypothetical case studies is not a guarantee or promise of future results. The financial markets and tax codes are subject to constant change, and acting on any information presented here without professional counsel carries significant risk. Imagine sitting across a massive, polished mahogany conference table in a high-rise legal office overlooking the San Francisco Bay, or perhaps staring out a window at the dense, towering skyline of Manhattan. You have just spent the last 10 to 15 years of your life building a career, a marriage, and a life in one of the most expensive coastal cities in the United States. You have diligently contributed the maximum allowable amount to your 401k every single year, capturing company matches and watching compound interest work its magic. You log into your brokerage account, and you see a balance of $1.5 million. You assume, as most people fundamentally do, that in the event of a divorce, this asset will simply be cut down the middle. You walk away with $750,000, your former spouse walks away with the same, and you both move on with your lives to start anew. This assumption is one of the most devastating, financially destructive illusions in the modern American divorce process. The reality of dividing a 401k, particularly in high-net-worth coastal environments, is a brutal awakening for thousands of professionals every year. Let us look closely at the architecture of that $1.5 million account. The first and most critical realization is that those dollars are not actually yours, at least not entirely, because traditional 401k contributions are made with pre-tax dollars. The number you see on your screen represents a gross figure that carries an embedded silent liability, future income tax. When couples negotiate the division of their assets, treating a pre-tax retirement account as a dollar-for-dollar equivalent to cash in a checking account or equity in a house is a catastrophic mathematical error. If you trade $500,000 of home equity for $500,000 in a traditional 401k, you have mathematically lost the negotiation before the ink on the settlement is even dry. But why are we specifically focusing on coastal cities? The geographical context of a divorce fundamentally alters the battlefield. If you reside in New York, Los Angeles, San Francisco, Seattle, Boston, or Miami, you are operating in a hyperinflated cost of living ecosystem. In these coastal hubs, the median price of a single-family home often exceeds $1 million. When a marriage dissolves in these environments, one spouse typically has to buy out the other's equity in the primary residence. Because housing is so astronomically expensive, couples are frequently entirely illiquid. All of their wealth is trapped in the drywall of their coastal home and the digital ledgers of their retirement accounts. Consequently, the 401k is inevitably dragged to the center of the negotiating table. It becomes the primary mechanism used to equalize the marital estate, essentially acting as the bank that funds the separation. This reliance on the 401k in high-cost cities introduces an intense layer of legal complexity dictated by state lines. The United States does not have a unified divorce law. If you are divorcing in California or Washington, you are dealing with community property laws, where assets acquired during the marriage are generally viewed as owned 50-50 by both spouses, regardless of whose name is on the paycheck or the account. If you are divorcing in New York or Massachusetts, you are subject to equitable distribution laws, where a judge divides the assets based on what they deem fair, taking into account the duration of the marriage, the earning capacity of both parties, and individual contributions. Yet, regardless of whether you are facing community property or equitable distribution, dividing a 401k cannot simply be done by writing a check or calling your broker to transfer shares. It requires a highly specialized, fiercely technical legal document called a Qualified Domestic Relations Order, or a QDRO. The QDRO is the silent assassin of the divorce process. It is an entirely separate legal order from your divorce decree. A judge can finalize your divorce, strike the gavel, and declare you single. But if the QDRO is not drafted precisely, submitted to your 401k plan administrator, and formally approved, the funds remain completely locked. And it is within this waiting period, the space between the divorce decree and the execution of the QDRO, that massive fortunes are inadvertently lost. Consider a scenario where the stock market experiences a severe, sudden downturn, while the QDRO is languishing in the bureaucracy of human resources departments and legal revisions. Who absorbs the loss if the account drops 20% in value before the funds are separated? Does the alternate payee still receive a flat, static dollar amount, forcing the account owner to shoulder the entirety of the market crash? Or was the agreement drafted to divide the account based on a percentage of the total shares, meaning both parties share the financial pain equally? There is a specific, often overlooked paragraph in a standard QDRO that dictates exactly how market fluctuations are handled between the date of separation and the date of distribution. Getting those 3 sentences wrong has forced executives to delay their retirement by a decade, just to recoup the losses of a mismanaged asset split. What exactly are those sentences, and why do even high-priced coastal attorneys routinely leave them entirely ambiguous? This masterclass is designed to answer that exact question and solve the massive knowledge gap surrounding retirement division. The problem we are solving today is the terrifying vulnerability of walking into a negotiation blind to the mechanics of your own wealth. Over the course of this deep dive, we are going to explore the historical trends of high-asset coastal divorces and examine detailed case studies of couples who successfully insulated their retirement from unnecessary tax penalties, juxtaposed against those who triggered massive IRS audits through simple clerical errors. We will break down the specific potential outcomes of liquidating a portion of a 401k to pay off a former spouse, and how certain exemptions under the Internal Revenue Code might allow an alternate payee to bypass the standard 10% early withdrawal penalty entirely, a strategy that has historically saved savvy negotiators tens of thousands of dollars. We will explore how different plan administrators at major tech and finance firms have unique, idiosyncratic rules regarding what a QDRO can and cannot mandate. By the end of this journey, you will possess a comprehensive, structural understanding of how a 401k is valued, taxed, and ultimately divided. You will be equipped with the vocabulary and the conceptual frameworks necessary to sit down with your legal team, not as a passive observer waiting for instructions, but as an informed, active strategist in the protection of your financial future. We are going to deconstruct the entire process, step by step, unearthing the hidden traps and illuminating the strategies that protect the wealth you have spent a lifetime building. To begin this deconstruction, we must first attack the most common and financially devastating optical illusion in the entire divorce process, which is the balance you see when you log into your retirement portal. We briefly touched upon the pre-tax nature of traditional 401k accounts, but understanding the precise mechanics of how this plays out in a live negotiation is what separates those who protect their wealth from those who unknowingly surrender it. When you are looking at a $1,401,000, you are looking at a gross asset. If you are in the highest tax bracket, which is incredibly common for dual-income professionals living in New York, San Francisco, or Boston, the actual net value of that account might be closer to $600,000 once state and federal taxes are eventually applied upon withdrawal. Trading a fully tax-paid, highly liquid asset like cash in a savings account or post-tax equity in a coastal home for an equivalent gross amount in a traditional 401k is a mathematical disaster. Let us examine a historical trend that is playing out right now in 2026 across the Pacific Northwest to illustrate exactly how this destroys marital wealth. Imagine a couple, Michael and Jessica, living in a high-cost suburb of Seattle, Washington. Washington is a strict community property state, meaning the wealth accumulated during their 10-year marriage is subject to a 50-50 split. Michael is a senior director at a major tech firm, and his 401k balance sits at exactly $1,200,000. In January of 2026, they officially separate. Through mediation, they agree that Jessica is entitled to exactly half of the marital portion of this account, which amounts to $600,000. Their respective family law attorneys draft the separation agreement, stating Jessica shall receive $600,000 from Michael's 401k. The judge signs the decree, and the divorce is finalized. This is exactly where the trap snaps shut. As we established, a divorce decree cannot move 401k money. Only a qualified domestic relations order, or QDRO, can execute that transfer. Drafting, reviewing, and getting a QDRO approved by the 401k plan administrator routinely takes 6 to 9 months. During this administrative limbo, the year progresses. It is now August of 2026. The stock market experiences a sharp, sustained correction. The value of Michael's 401k plummets from $1.2 million down to $900,000. Because their settlement agreement stated Jessica was to receive a flat dollar amount of $600,000, the QDRO is executed based on that specific language. The plan administrator liquidates $600,000 from the account and transfers it to Jessica. Michael is left with the remaining balance. Because he agreed to a static flat dollar payout instead of a percentage-based division, Michael has inadvertently absorbed 100% of the market loss. He is left with just $300,000, effectively losing half of his expected post-divorce net worth simply because his legal team failed to account for market volatility between the date of separation and the date of actual distribution. An informed negotiator never allows a flat dollar amount to dictate the division of a market-linked asset. The strategic approach is to draft the settlement and the QDRO using a percentage formula, explicitly stating that the alternate payee receives 50% of the account balance as of the exact date of separation, plus or minus all subsequent investment gains and losses until the actual date of segregation. This single sentence ensures that both parties share equally in the upside of a bull market and the downside of a market correction during the months it takes the legal system to process the paperwork. Now, let us layer in the unique pressures of the coastal city housing market. In our 2026 scenario, Jessica finds herself facing a Seattle real estate market where purchasing a modest townhome requires massive upfront liquidity. She cannot wait until she reaches the standard retirement age to access these funds. She needs capital immediately to secure housing and reestablish her life. This introduces a highly specific, frequently misunderstood provision within the Internal Revenue Code that serves as a double-edged sword for divorcing spouses. Under standard circumstances, withdrawing funds from a 401k before the age of 59.5 triggers a severe 10% early withdrawal penalty from the IRS, on top of ordinary income taxes. However, when an alternate payee receives funds from a 401k through a legally executed QDRO, they are granted a rare exemption. Historically, this exemption allows the alternate payee to take a direct cash distribution from the 401k without being hit by that 10% early withdrawal penalty. For a spouse needing immediate liquidity to survive in a hyper-expensive coastal environment, this sounds like a perfect lifeline. But avoiding the early withdrawal penalty does not mean you have avoided the tax liability. This is the secondary trap that bankrupts newly divorced individuals. If Jessica elects to take her $600,000 QDRO award as a direct cash payout to fund her Seattle real estate purchase, the IRS immediately classifies that entire sum as ordinary income for the 2026 tax year. She is instantly catapulted into the highest possible federal tax bracket. Furthermore, the 401k plan administrator is legally required by federal law to automatically withhold 20% of that cash distribution for prepayment of federal taxes. Jessica expects a deposit of $600,000 to buy her home. Instead, she receives $480,000. But the nightmare is only beginning. Because that massive lump sum pushed her into the top tax tier, her actual effective tax rate combined with state taxes could easily approach 40%. When April of the following year arrives, she discovers that the mandatory 20% withholding was vastly insufficient. She is suddenly hit with a six-figure tax deficiency by the IRS, utterly destroying the financial stability she thought she had secured. The strategy to navigate this requires meticulous staging. If immediate liquidity is not absolutely essential, the optimal path is almost always a direct trustee-to-trustee transfer, rolling the awarded QDRO funds directly into the alternate payee's own traditional IRA. This maneuver is a non-taxable event. It preserves the pre-tax status of the capital, maintains compound growth, and triggers zero immediate tax liabilities. If liquid capital is strictly required for survival, the withdrawal must be calculated with absolute precision, alongside a certified tax professional to determine the exact withholding necessary to prevent a catastrophic audit the following spring. You must also understand that you are not just negotiating against your spouse and the IRS. You are negotiating against the specific bureaucracy of the corporation holding the 401k. Every single 401k plan is governed by a dense document called the Summary Plan Description. The rules within this document dictate exactly what a QDRO can and cannot compel the company to do. You might spend $10,000 in legal fees drafting a highly customized QDRO that perfectly outlines a tiered payout structure, only to have the tech company's plan administrator reject it outright because their specific internal rules only allow for a single one-time lump sum transfer. Assuming all 401k plans operate under identical rules is a critical failure in the preparation phase. You have now successfully navigated the valuation trap and the immediate tax landmines of a cash distribution. But what happens if that 401k is not actually whole? What if, 2 years before the divorce, you took out a massive $50,401,000 loan to fund the down payment on your coastal property, and that loan is still outstanding when the judge finalizes your split? If handled incorrectly, that phantom debt will detonate, triggering an irreversible tax bomb that could bankrupt one spouse overnight, and the legal mechanism to stop it is buried in a document your lawyer might not even be reading. That document is the summary plan description, and the phantom debt we are talking about is the ubiquitous 401k loan. In coastal cities like Los Angeles, Miami, or Boston, where housing affordability is severely strained, borrowing against retirement accounts to secure a down payment is not just common. It is a historical trend we see accelerating into 2026. When you take a loan against your 401k, you are essentially borrowing your own money, paying yourself back with interest through automatic payroll deductions. On paper, it looks harmless. It feels like a smart internal financial maneuver that bypasses traditional bank underwriters. But a 401k loan is not a traditional debt. It is a conditional withdrawal. The condition keeping the Internal Revenue Service at bay is your continuous employment with that specific company and the uninterrupted flow of those payroll deductions. When a divorce enters the equation, it fundamentally destabilizes the financial infrastructure keeping that loan compliant. Imagine if we look at a highly typical scenario unfolding right now in 2026. David and Sarah reside in Los Angeles, California. 3 years ago, they wanted to buy a property in the San Fernando Valley. Short on liquid cash for the massive down payment required in the California market, David utilized the maximum allowable provision under federal law and borrowed $50,000 from his corporate 401k. Fast forward to the present day, and they are navigating the dissolution of their marriage. David still owes $35,000 on that loan. His total 401k balance shows as $400,000, but that number includes the outstanding loan note. Here is where standard legal representation typically fails. A boilerplate marital settlement agreement might simply state that the 401k is to be divided equally 50-50. The attorneys draft the qualified domestic relations order and send it to the plan administrator. But the plan administrator operates under strict federal regulations and the highly specific rules of their corporate plan. In the vast majority of cases, a plan administrator will not, and legally cannot, transfer a portion of a loan to an alternate payee. Sarah cannot legally take on half of David's 401k loan because she is not an employee on that specific payroll system. The loan itself cannot be divided. Therefore, the administrator calculates the division based solely on the liquid assets available. They strip the $35,000 loan out of the equation, give Sarah her half of the actual cash value, and leave David holding the entirety of the debt. But the catastrophe goes much deeper than just an uneven asset split. Divorce often triggers significant life and career changes. What if David decides he needs to leave his demanding corporate job in Los Angeles to relocate for a fresh start? Or perhaps he is unexpectedly laid off during a corporate restructuring. The moment David separates from his employer, the ticking time bomb detonates. The 401k plan rules dictate that upon termination of employment, any outstanding loan balance must be repaid in full, typically within a very short window, often by the due date of his next federal tax return. David, having just gone through an incredibly expensive California divorce and having lost half of his liquid retirement assets, does not have $35,000 in cash to pay back the plan. He defaults. The moment that default occurs, the Internal Revenue Service immediately classifies that unpaid $35,000 as a deemed distribution. It is instantly added to his taxable income for the year. Furthermore, if he is under the age of 59 and a half, he is also slammed with the standard 10% early withdrawal penalty. David is now facing a massive unexpected tax bill on money he spent years ago on a house that, due to the divorce, he might not even own anymore. How do elite financial analysts and specialized divorce attorneys prevent this outcome? They neutralize the phantom debt before the QDRO is ever drafted. The strategy requires identifying the outstanding loan during the initial financial discovery phase. Instead of ignoring it or assuming the plan administrator will magically figure it out, The legal team must factor the debt into the broader equitable distribution of the entire marital estate. If David is retaining the burden of the $35,000 loan, he must be compensated with an offsetting asset elsewhere. Perhaps he receives an additional $35,000 in home equity from the sale of the San Fernando Valley property, or he keeps a larger percentage of a separate, post-tax brokerage account. The settlement agreement must explicitly state how the outstanding loan affects the overall division, protecting the employee spouse from absorbing a marital debt entirely alone and subsequently triggering a unilateral tax disaster. Furthermore, failing to explicitly account for the loan creates a severe imbalance in how market gains are distributed during the administrative waiting period we discussed earlier. The money tied up in the loan is not invested in the stock market. It is sitting as a fixed income promissory note. If the stock market experiences a massive bull run during the 6 to 9 months it takes to finalize the QDRO, the liquid portion of the 401k surges in value, while the loan portion remains entirely stagnant. If the agreement simply said to divide the total account balance equally, Sarah receives a disproportionate share of the market gains because her half is pulled entirely from the actively invested, liquid funds. David, conversely, is left with the stagnant loan note and a severely depleted invested balance. The mathematical asymmetry is staggering and entirely preventable. A meticulously drafted QDRO must explicitly instruct the plan administrator to exclude the outstanding loan balance from the calculation of the alternate payee's award, ensuring the division is based purely on the actively invested assets. This requires a level of precision that a general practice family law attorney simply might not possess. You must demand that your legal team reviews the summary plan description specifically for the provisions governing loan treatment during a divorce proceeding. You must confirm whether the plan uses a pro rata distribution method across all mutual funds in the account, or if it allows the alternate payee to carve their share out of specific asset classes to optimize their own post-divorce portfolio. Every single detail matters when hundreds of thousands of dollars are on the line in a coastal economy that leaves absolutely zero margin for error. You have now insulated yourself against the tax penalties, you have accounted for market volatility, and you have neutralized the phantom debt of a 401k loan. You feel secure. After all, you had $200,000 in this exact 401k account for 5 years before you even met your spouse. That money was earned before the marriage, so it is strictly yours, untouchable by the divorce courts. That is what basic logic dictates. But the family court system in the United States does not operate on basic logic. It operates on historical precedent and strict documentary evidence. In places like New York or California, the legal concept of commingling and the absolute nightmare of financial tracing can turn your protected premarital safe haven into divisible community property in the blink of an eye. If you think your premarital retirement funds are automatically safe from your former spouse, you are walking into the most devastating ambush of the entire process. Let me show you exactly how one routine payroll deposit can legally vaporize a decade of your premarital savings. The concept seems simple enough on the surface. If you entered a marriage with a specific asset, that asset fundamentally remains yours when you eventually leave. In the legal realm, this is broadly classified as separate property. But the fatal flaw in this assumption is how modern retirement accounts actually function mechanically in the real world. A traditional 401k is not a stagnant vault buried in the ground. It is a living, breathing financial ecosystem. Every 2 weeks, your employer deposits a percentage of your paycheck into that account. During a marriage, that paycheck is legally recognized across the country as marital property, regardless of whose name is on the physical check. Therefore, every single bi-weekly contribution you make after your wedding day is systematically injecting marital funds directly into your separate property account. In family law, this gradual blending process is known as commingling. You can visualize this by imagining taking the pure water of your premarital savings and mixing it with the dark dye of your marital income. Over 5, 10, or 15 years of continuous payroll contributions, employer matches, mutual fund rebalancing, dividend reinvestments, and daily market fluctuations, that water becomes completely and irreversibly saturated with dye. The family court system does not view that active 401k as two distinct, easily separated piles of money. It sees a single, thoroughly blended asset. In high-stakes legal jurisdictions like New York and California, the strict legal presumption is almost always that all commingled assets are entirely marital property, unless definitively proven otherwise. The burden of proof rests entirely on your shoulders, as the account holder, to mathematically extract and verify that original premarital value. Imagine if we examine a deeply complex case study unfolding in San Francisco right now in 2026. Robert, a senior software engineer, marries Emily. On the exact day of their wedding, Robert has exactly $200,000 sitting in his corporate 401k. They remain married for exactly 10 years. Throughout that entire decade, Robert continues working for the exact same tech company, continuously contributing a portion of his marital income to that exact same 401k account. Today, as they file for divorce, the account balance has swelled through a massive bull market to $1,200,000. Robert confidently sits in his attorney's office and states that $200,000 is strictly his separate property, and they only need to legally divide the remaining $1 million. His attorney will immediately deliver a harsh dose of legal reality. That initial $200,000 did not just sit there in a vacuum for 10 years. It was actively invested in various index funds. It grew aggressively alongside the new marital contributions. To legally protect that initial sum, Robert cannot simply subtract $200,000 from the current balance. He must mathematically prove exactly how much of that specific $200,000 grew over the decade, separating its passive appreciation from the active contributions made during the marriage, and crucially separating it from the compound growth of those subsequent marital contributions. This requires a highly specialized, intensely expensive process called financial tracing. To execute a financial trace, Robert must hire a forensic accountant to completely reconstruct 10 years of monthly account statements. This accountant must identify every single payroll deposit over a decade, calculate the exact daily rate of return for the specific mutual funds held in the account, separate the dividend yields, and apply a complex algorithm to isolate the premarital principal and its specific, uncontaminated growth. This sounds straightforward until you realize that over a 10-year period, brokerage firms often merge, change their digital platforms, or purge old records. If Robert's employer switched their 401k provider from one major financial institution to another 5 years ago, obtaining those historical, day-by-day transaction ledgers becomes a logistical nightmare. In the coastal city legal market of 2026, hiring a forensic accountant to perform a comprehensive historical tracing on a decade-old 401k can easily cost between $15,000 and $30,000 in upfront retainer fees alone. Robert is immediately faced with a brutal cost-benefit analysis. Does he spend $25,000 on a forensic expert to potentially save $100,000 of his own equity, knowing that Emily will likely hire her own forensic accountant to challenge the methodology? If Emily's expert argues that Robert actively logged into his portal and shifted allocations between a target date fund and an aggressive growth fund during the marriage, they will claim this constitutes active management. In many courts, active management utilizing marital effort converts passive premarital growth into active marital property. If the judge finds Robert's tracing evidence insufficient or incomplete due to a single missing quarterly statement from 7 years ago, the default ruling is often to classify the entire $1,200,000 balance as community property, completely wiping out Robert's premarital safe haven. Because comprehensive forensic tracing is so prohibitively expensive and inherently risky, many high-net-worth couples in coastal cities are ultimately forced to rely on a secondary legal mechanism known as the coverture fraction, which is also commonly referred to as the time rule. This is a mathematical shortcut frequently used by the courts to estimate the marital portion of a retirement account based purely on the duration of the marriage relative to the lifespan of the account. The formula takes the total time the employee participated in the 401k plan while married and divides it by the total time the employee participated in the plan overall. Let us carefully apply this specific formula to Robert's situation. Suppose Robert worked at his tech company and contributed to his 401k for exactly 5 years before the marriage, and then 10 years during the marriage, resulting in a total of 15 years of plan participation. Under the coverture fraction, the court determines that 10 out of the 15 years were marital. 10 divided by 15 equals roughly 66.6%. Therefore, the court dictates that 66.6% of the total $1,200,000 balance is marital property, which is then subject to division. This sounds incredibly fair and efficient on the surface, but it is often mathematically catastrophic for the individual who heavily front-loaded their retirement savings in their 20s. The coverture fraction assumes a perfectly linear, equal rate of contribution and growth across all 15 years. It completely ignores the fundamental reality of compound interest. Robert's initial $200,000 had a massive 5-year head start. It was compounding at a much higher volume during the marriage than the smaller incremental payroll contributions being made along the way. By using a flat, time-based percentage, the coverture fraction severely dilutes the true value of Robert's premarital wealth, effectively transferring years of his independent, hard-earned compound growth directly into the marital estate without any regard for actual market performance. The historical trend among successful coastal professionals reveals only one foolproof method to prevent this entire legal catastrophe, and it requires proactive segregation long before a divorce is ever considered. If you are entering a marriage with a substantial 401k from a previous employer, the strategy is to roll that premarital 401k directly into a completely separate traditional IRA. You never, under any circumstances whatsoever, contribute a single penny of your marital income to that specific IRA. By erecting an absolute, impenetrable firewall between your premarital principal and your postmarital income, you eliminate the commingling problem entirely. The account remains distinctly yours, its growth remains unequivocally yours, and no forensic accountant will ever be required to untangle it. But protecting standard mutual funds and index-based 401k assets is elementary compared to the absolute labyrinth we are about to enter. What happens when your coastal employer matches your 401k contributions not with traditional cash, but with highly restricted, unvested company stock? What if your retirement wealth is intrinsically tied up in a proprietary employee stock ownership plan that explicitly forbids non-employees from ever holding shares? The exact moment unvested equity enters the divorce negotiation, the standard rules of asset division completely shatter, leaving couples violently fighting over phantom money that does not mathematically exist yet. To comprehend the absolute chaos that unvested equity introduces into a coastal divorce, we must dissect the very nature of modern corporate compensation. In hyper-competitive markets like Silicon Valley, Seattle, and the financial districts of Manhattan, a massive portion of a professional's total wealth is no longer paid in liquid cash salaries. It is paid in restricted stock units, commonly known as RSUs, or complex tiered stock options. These are incredibly lucrative instruments, but they carry a fundamental structural catch. When a tech conglomerate grants you $1 million in RSUs, they do not hand you the shares that day. They hand you a vesting schedule. You might receive 25% of those shares after 1 year, which is known as the cliff, and the remainder might vest incrementally every month or quarter over the next 3 years. Until those shares officially vest and hit your brokerage account, they are completely unvested. They are legally nothing more than a corporate promise contingent upon your continued employment. If you quit or if you are fired, that unvested equity instantly vaporizes. Imagine a scenario unfolding right now in 2026 in Palo Alto, California. James is a senior artificial intelligence researcher at a dominant tech firm. He is married to Elena. 2 years ago, James received a massive retention grant of 4,000 restricted stock units. At the current market valuation in 2026, those shares are worth roughly $1.6 million. However, only 2,000 of those shares have actually vested. The remaining 2,000 shares, representing $800,000 in potential wealth, are unvested and will not become liquid for another 24 months. James and Elena file for divorce today. During mediation, a vicious legal battle ignites over those unvested shares. James, utilizing standard corporate logic, argues that the unvested RSUs are strictly his separate property. His legal team contends that because the shares require him to continue working at the company for the next 2 years, long after the marriage has ended, they represent compensation for future, postmarital labor. Elena's legal team violently disagrees. They argue that the initial stock grant was awarded during the marriage as a direct result of marital effort and the reputation James built while married. Therefore, Elena claims she is entitled to exactly half of the entire $1.6 million grant, regardless of the vesting timeline. This specific dispute paralyzes thousands of high-asset divorces every single year, and the legal resolution relies entirely on the precise wording of the original corporate grant documents. The family court system must determine the primary purpose of that unvested equity. Was the grant intended to reward James for past performance? Or was it entirely designed as an incentive to retain him for the future? To solve this, courts in community property states often deploy a highly complex mathematical formula, frequently referred to as a time rule or the Nelson formula, named after historical case law. This formula creates a specific fraction to determine the marital portion of unvested stock. The numerator of this fraction is the total number of months from the date the stock was granted to the exact date the couple legally separated. The denominator is the total number of months from the date the stock was granted to the date the stock finally vests. Let us apply this to James and Elena. The stock was granted 24 months ago. They are separating today. The total vesting schedule is 48 months. So the numerator is 24, and the denominator is 48. This creates a fraction of 24 over 48, or exactly 50%. Under this specific historical application, the court rules that 50% of those future, unvested shares are legally marital property, and Elena is entitled to half of that marital portion. But establishing who owns the phantom money is only the first nightmare. The second, much more dangerous trap is the physical mechanics of actually dividing it. You cannot simply use a qualified domestic relations order to transfer unvested stock. Corporate HR departments and plan administrators operate under ironclad rules. They will categorically refuse to transfer unvested RSUs or stock options into the name of a non-employee spouse. The corporate entity does not know Elena. They do not employ Elena, and they will not put restricted company stock in her external brokerage account. To bypass this impenetrable corporate wall, elite divorce attorneys utilize a mechanism called a constructive trust. The settlement agreement legally mandates that James must hold Elena's portion of the unvested shares in his own name. He is legally transformed into a fiduciary, acting essentially as a trustee for his former spouse. As the months pass and those specific shares finally vest, James is legally obligated to immediately liquidate Elena's share of the stock and transfer the cash equivalent directly to her. This sounds like a brilliant workaround, but it creates a terrifying tax trap for the employee spouse if the settlement is drafted by an amateur. When RSUs vest, the Internal Revenue Service treats that event as ordinary W-2 income. The exact moment those shares become liquid, their total market value is added to James's taxable income for the year, and his employer will automatically withhold a massive chunk of the shares, often upwards of 30 to 40% in California, simply to cover the supplemental federal and state income taxes. If James's divorce settlement simply states that he must transfer 50% of the vested shares to Elena, he is stepping onto a financial landmine. He would be legally obligated to give Elena the gross amount of her shares, while he alone absorbs the entire massive W-2 income tax liability generated by the vesting event. He would effectively be paying taxes on his ex-wife's money out of his own pocket. To prevent this catastrophic outcome, a highly sophisticated marital settlement agreement must explicitly detail a net after-tax transfer protocol. The language must mandate that upon vesting, James will calculate the specific tax liability generated solely by Elena's portion of the shares, subtract those taxes, and only deliver the remaining net cash to her. Navigating the phantom income of a constructive trust requires the exact precision of a certified tax professional working directly alongside the family law attorney. Yet, even with a perfectly drafted constructive trust and airtight tax indemnification clauses, you are still dealing with an asset tied to future employment. What happens if 6 months after the divorce is finalized, the tech industry experiences a massive 2026 contraction? James is laid off as part of a 10,000-person corporate restructuring. Because his employment is terminated, all of his unvested shares instantly evaporate. They return to the company. Under the terms of the constructive trust, Elena's awarded shares also evaporate. She receives absolutely nothing. Or consider a more malicious scenario. What if James intentionally quits his high-paying tech job just to spite Elena, deliberately detonating the unvested equity so she cannot profit from it, only to immediately take a similar job at a rival firm with a massive new sign-on bonus? This is a notorious tactic in high-conflict divorces. To combat this, specialized legal teams build explicit clawback clauses and alternative compensation triggers into the divorce decree. These clauses state that if the employee spouse voluntarily terminates their employment or is fired for cause, thereby destroying the unvested marital equity, they are legally required to compensate the alternate payee from their other remaining separate assets. We have now completely deconstructed the corporate architecture of traditional 401ks, the phantom debt of loans, the forensic nightmare of commingled premarital funds, and the invisible warfare of unvested equity. But everything we have discussed so far assumes you work for someone else. It assumes there is a massive corporate human resources department and an independent plan administrator acting as a neutral third party to execute these complex divisions. What happens when you are the chief executive officer, the sole employee, and the plan administrator of your own company? When high-net-worth business owners utilize solo 401ks or specialized defined benefit plans, the separation of corporate identity and personal wealth completely dissolves. The strategies for division are no longer just about asset allocation. They become a surgical invasion into the very operational heart of the business itself, and the risk of unintentionally piercing the corporate veil in family court is the single greatest threat a self-employed professional will ever face. The surgical invasion begins the moment a self-employed professional in a city like Boston or Austin realizes their solo 401k is not a protected fortress, but a transparent glass box in the eyes of a divorce court. For the high-earning consultant, the boutique agency owner, or the freelance software architect, the solo 401k is often the crown jewel of their financial planning. It allows for massive contribution limits, frequently exceeding $60,000 annually depending on income levels, because the individual acts as both the employee and the employer. But in 2026, as the IRS and family courts increase their scrutiny of self-directed retirement vehicles, the very flexibility that makes the solo 401k attractive becomes its greatest liability during a marital dissolution. When you work for a Fortune 500 company, the plan administrator is a faceless institutional entity that follows rigid, pre-established protocols. When you are the plan administrator of your own solo 401k, the court views you as a fiduciary with total control. This creates a psychological and legal battlefield where your former spouse's legal team will attempt to prove that you have used the retirement account as a personal piggy bank or a tool for asset hiding. This brings us to the terrifying concept of piercing the corporate veil within the context of retirement assets. If a judge determines that you have not maintained a strict, formal separation between your business operations and your 401k management, perhaps by failing to file required annual Form 5500 Easy reports once the plan assets exceeded $250,000, the court may decide to treat the entire account as a standard, non-protected liquid asset, stripping away the ERISA protections that usually shield retirement funds from creditors and certain legal claims. Let us look at a case study involving a character named Marcus, a highly successful independent medical consultant living in Miami, Florida. Marcus established a solo 401k 5 years into his marriage. By 2026, through aggressive profit-sharing contributions and smart market plays, the account has reached a value of $800,000. Marcus is the sole trustee. His wife, Sophia, has never been an employee of his consulting firm. As their divorce progresses, Marcus assumes he can simply manage the division himself. He thinks he can just write Sophia a check from his business account to buy out her interest in the 401k, or perhaps just move some stocks around. This is a catastrophic tactical error. Because Marcus is the trustee, any move he makes that does not strictly adhere to Department of Labor and IRS regulations can trigger a prohibited transaction. If Marcus attempts to use 401k funds to pay off a personal marital debt, or to settle a portion of the divorce without a formal qualified domestic relations order, he risks the immediate disqualification of the entire plan. In the eyes of the IRS, a disqualified solo 401k is treated as if the entire balance was distributed to the owner on the first day of the year. For Marcus, this would mean his $800,000 nest egg is suddenly hit with a combined federal and state tax bill that could exceed $350,000, plus penalties, all because he treated his retirement account like a personal brokerage account. The complexity intensifies when we introduce the concept of the defined benefit plan, a strategy historically favored by the highest-earning coastal professionals in 2026 to stash away hundreds of thousands of dollars in tax-deferred income annually. Unlike a 401k, which is a defined contribution plan with a visible balance, a defined benefit plan is a promise of a future monthly payment based on an actuarial formula. Valuing this in a divorce is not as simple as looking at a website. It requires hiring an actuary to perform a present value calculation. They must take the projected future monthly payments, apply a discount rate based on current 2026 interest rates, and factor in Marcus's statistical life expectancy to arrive at a single lump sum dollar amount that represents the marital portion today. Imagine if the actuary determines the present value of Marcus's future pension is $1.2 million. Sophia is entitled to half of the marital portion of that value. Marcus now faces an impossible liquidity crisis. His wealth is tied up in a complex pension structure designed to pay out 20 years from now, but his divorce settlement requires him to equalize the estate today. In coastal cities where the cost of living is already suffocating, Marcus might be forced to sell his primary residence or liquidate his non-retirement investments just to pay Sophia her share of a pension he cannot even touch yet. This leads us to the strategic use of the offset method, versus the reserved jurisdiction method. In the offset method, Marcus would give Sophia other assets, like the equity in their Miami condo or a larger share of a joint brokerage account, in exchange for keeping his retirement plan intact. This is the preferred route for high-income earners who want a clean break. However, it requires a massive amount of non-retirement liquidity if the couple is house-rich and cash-poor. A common historical trend in 2026 coastal markets, they must use reserved jurisdiction. This means the court retains authority over the plan, and Sophia will receive her share of the payments only when Marcus eventually retires, years or decades down the line. This links their financial lives together indefinitely, a prospect that many find intolerable. But there is a hidden danger in the reserved jurisdiction method that most general practice lawyers overlook: the death of the participant. If the QDRO is not drafted with specific survivor benefit language, and Marcus passes away before or shortly after retirement, Sophia's interest in that defined benefit plan could vanish instantly. The plan might simply stop paying, leaving her with zero. To prevent this, the legal team must secure a qualified pre-retirement survivor annuity and a qualified joint and survivor annuity. These are technical riders within the QDRO that ensure the former spouse's share is protected regardless of the participant's lifespan. Now, consider the specialized scenario of a business owner whose 401k is not filled with stocks and bonds, but with alternative assets. In 2026, we see an increasing number of self-directed solo 401ks holding private equity, physical real estate, or even high-value intellectual property. How do you divide a 401k that owns 50% of a multifamily apartment building in Brooklyn? You cannot split a building with the QDRO. The administrative burden of retitling assets held within a retirement trust is a logistical nightmare that can ground a divorce to a halt for years. The level of precision required here is absolute. One misstep in the valuation of a private asset or one error in the actuarial assumptions of a pension plan can result in a transfer of wealth that is hundreds of thousands of dollars off the mark. And yet, even if you master the solo 401k and the defined benefit plan, you are still only looking at the assets you have already built. You have not yet considered the most controversial and highly litigated financial asset in the coastal professional's portfolio: the Social Security offset and the hidden reality of how your future government benefits can be used as a weapon to reduce your 401k payout. If you think your 401k and your Social Security are two separate buckets that never touch, you are about to discover a legal doctrine that could cost you your entire retirement strategy. The intersection of Social Security and 401k division is one of the most intellectually dense and frequently ignored territories in the landscape of American family law. Most coastal professionals, particularly those in high-pressure sectors like tech in Seattle or finance in Manhattan, view Social Security as a distant, secondary benefit that has no bearing on their private 401k assets. However, in 2026, the legal concept of the Social Security offset has emerged as a powerful counterintuitive tool used by elite forensic accountants to rebalance the scales of a marital estate. While Social Security benefits themselves are strictly governed by federal law and cannot be divided by a state court judge through a QDRO, the value of those future benefits can be calculated and used as a heavy thumb on the scale when deciding exactly how much of the 401k each spouse receives. To understand how this functions, we must first look at the federal preemption doctrine. Under the Social Security Act, these benefits are not considered marital property. A judge cannot order the Social Security Administration to send half of your future check to your ex-spouse. However, in states like Ohio, Pennsylvania, and increasingly in certain equitable distribution cases across the coastal corridor, courts have developed a workaround. They look at the total retirement picture. If one spouse has spent 20 years in the private sector accumulating a massive 401k while paying into Social Security, and the other spouse has spent 20 years in a public sector job, such as a teacher in Boston or a civil servant in San Francisco, where they participated in a government pension instead of Social Security, a massive inequity is created. Let us examine a detailed case study unfolding in 2026 involving a character named Linda and her husband, Mark, living in Alexandria, Virginia. Mark is a senior consultant for a federal contractor with a 401k balance of $900,000. He has paid the maximum Social Security tax for 25 years. Linda is a high-level administrator for a local municipality. She does not pay into Social Security. Instead, she has a robust government pension. In a standard divorce, the court would divide Mark's 401k and Linda's pension. But wait, Linda will receive her full pension, while Mark will receive his half of the 401k plus his full Social Security check. Because Linda's pension is viewed as a substitute for Social Security, Mark's legal team argues for a Social Security offset. They hire a forensic actuary to calculate the present value of Mark's expected Social Security benefits. Let us say the actuary determines that Mark's future Social Security stream is worth a present-day lump sum of $400,000. The legal team then argues that this $400,000 should be treated as if it were a retirement asset already in Mark's column. When it comes time to divide the $900,401,000, the court may decide that because Mark effectively has $400,000 in invisible Social Security wealth, Linda should receive a larger portion of the 401k to achieve true mathematical equity. Instead of a $450,000 split, Linda might walk away with $650,000 of the 401k, leaving Mark with only $250,000 of his own account. Mark is left relying on a government benefit he cannot access for another decade, while Linda leaves the marriage with liquid, invested capital. This historical trend of offsetting Social Security value against private 401k assets is a silent wealth killer for those who do not anticipate the calculation. Beyond the offset, we must address the 2026 reality of the Social Security divorced spouse benefit. Many people are unaware that if your marriage lasted at least 10 years, you may be eligible to receive benefits based on your former spouse's earnings record, even if they have remarried. This does not reduce the amount the worker receives, and it does not reduce the amount their new spouse receives. It is an independent benefit provided by the federal government. For a lower-earning spouse in an expensive city like San Diego, this benefit can be a critical component of their long-term survival. However, there is a catch. If you remarry, you generally lose the right to claim against your former spouse's record. This creates a specific financial incentive in 2026 where high-net-worth divorcees are strategically choosing long-term cohabitation over legal remarriage to preserve their claim to a high-earning ex-spouse Social Security bracket. Now, let us shift our focus to an even more granular and high-risk area: the 401k valuation of the international professional. In coastal hubs like New York, Miami, and Los Angeles, it is incredibly common in 2026 for one or both spouses to be foreign nationals or U.S. citizens who spent significant time working abroad. This introduces the nightmare of the multi-jurisdictional retirement split. If you have a 401k in the United States but also a superannuation fund in Australia, a registered retirement savings plan in Canada, or a statutory provident fund in Singapore, you are no longer just dealing with a QDRO. You are dealing with international treaties and the risk of double taxation. Imagine a character named Elena, a fintech executive in Manhattan, who worked in London for 6 years before transferring to the New York office. She has a standard US 401k, but she also has a substantial United Kingdom pension. Her husband, Christopher, wants his half of both. A US judge can sign a QDRO for the 401k, but a US court has absolutely zero jurisdiction over a British pension provider. The UK plan administrator will look at a US court order and move it directly into the trash can. To divide that international asset, Elena and Christopher must initiate a secondary legal action in the UK courts to obtain a pension sharing order. The costs of this are staggering. You are now paying for 2 sets of attorneys, 2 sets of forensic accountants, and navigating 2 entirely different tax codes. In 2026, the IRS has become increasingly aggressive regarding the disclosure of foreign retirement accounts. If Elena failed to properly disclose her UK pension on her FBAR or FATCA filings during the marriage, the divorce process will unearth this omission. What started as a simple asset division can quickly spiral into a multi-year federal tax audit with penalties that can exceed the actual value of the retirement account itself. Furthermore, the tax treatment of these transfers is rarely symmetrical. While a QDRO transfer is typically tax-free between U.S. spouses, an international pension transfer might trigger immediate exit taxes in the home country or be viewed as a taxable distribution by the IRS. Historical trends show that many international couples in coastal cities eventually abandon the pursuit of splitting foreign accounts and instead use the offset method we discussed earlier, giving the U.S.-based spouse more of the 401k in exchange for the other spouse keeping the foreign pension entirely. But this requires an incredibly precise valuation of the foreign asset, accounting for currency fluctuations in 2026, local tax laws, and the lack of liquidity. We have explored the invisible weight of Social Security and the global complexity of international retirement funds. You are seeing the full picture of how a 401k is not just a number, but a node in a massive global web of legal and tax obligations. But there is one final devastating variable that can override every strategy we have discussed. It is the one thing that no QDRO, no forensic accountant, and no premarital tracing can protect you from. It is the concept of marital waste and the intentional dissipation of assets. If, during the breakdown of the marriage, you or your spouse made certain financial moves within that 401k, perhaps to fund a secret life, a failing business venture, or a high-risk investment that went to zero, the court has the power to engage in a legal fiction called the reconstituted estate. They can pretend the money still exists and charge it entirely to your side of the ledger. And in the high-stakes, high-stress environments of the 2026 coastal elite, the line between a bad investment and legal marital waste has become dangerously thin. The concept of marital waste, or the dissipation of assets, is the legal system's way of correcting for financial bad faith. In the context of a 401k, it is not simply about making a poor investment choice. It is about the intentional or reckless depletion of marital funds for a non-marital purpose during the period when the marriage is undergoing an irreconcilable breakdown. In high-pressure coastal environments like San Jose, California, or the tech corridors of Northern Virginia, where 401k balances often represent the largest liquidable asset, the temptation to tap into these funds during a period of emotional volatility is immense. But the legal repercussions in 2026 are swifter and more data-driven than ever before. To visualize this, let us examine a high-stakes scenario involving a character named Thomas, a senior data scientist in San Francisco. In early 2026, as his marriage to Sarah began to dissolve, Thomas felt a sense of panic regarding his future liquidity. Without consulting Sarah, Thomas utilized a provision in his 401k that allowed for self-directed brokerage access. He liquidated $500,000 worth of stable index funds and moved the entirety of that capital into a highly speculative, unproven series of leveraged cryptocurrency derivatives and pre-IPO startup equity belonging to a friend's venture. By the time the divorce reached the discovery phase 6 months later, those investments had lost 80% of their value. Thomas claimed it was simply a series of bad market moves, a potential outcome for any investor. Sarah's legal team, however, filed a claim for marital waste. In the California court system of 2026, the judge looked at several key factors to determine if this was a legitimate investment loss or dissipation. First, the timing. The trades occurred exactly 3 weeks after Thomas moved out of the marital home. Second, the lack of transparency. He intentionally hid the statements from Sarah. Third, the departure from historical trends. For 15 years, Thomas had been a conservative boglehead investor, only to suddenly pivot to high-risk gambling the moment the divorce became imminent. The court ruled that Thomas had committed marital waste. To remedy this, the judge utilized the doctrine of the reconstituted estate. The court acted as if the $400,000 Thomas lost still existed in the 401k. When it came time to divide the remaining assets, the judge deducted that $400,000 loss entirely from Thomas's share of the marital estate. If the total marital pot was $2 million, the court treated it as $2.4 million. Sarah received her full $1.2 million, while Thomas was left with only $400,000 in actual cash and a pile of worthless equity. He was forced to pay for his financial recklessness with real surviving dollars. This historical trend of penalizing dissipation is not limited to bad investments. In 2026, we see an increase in cases where 401k loans are used to fund secret lifestyles or to pay for high-end coastal rentals during a separation. If you take a $50,000 loan against your 401k to pay for a luxury bachelor pad in Malibu or to fund a new relationship, the court will almost certainly classify that loan as your separate debt, but they will credit the withdrawal against your share of the assets. You are essentially spending your own divorce settlement before you even receive it, and you are doing so in the most tax-inefficient way possible. Beyond the intentional destruction of assets, we must address the accidental destruction of a 401k through the failure to manage the beneficiary designations. This is the silent killer of retirement wealth that often strikes after the divorce is finalized. Many people assume that a divorce decree automatically revokes their ex-spouse status as a beneficiary on their 401k. This is a lethal misunderstanding of federal law. 401k plans are governed by the Employee Retirement Income Security Act, or ERISA. Federal courts have historically ruled that ERISA preempts state laws. Even if your state has a law saying divorce revokes beneficiary status, the 401k plan administrator is legally required to pay the person listed on the official beneficiary form. Imagine a case study from 2026 involving a character named Michael in Boston. Michael divorced his first wife, Jennifer, in 2022. The divorce was bitter, and the 401k was split via QDRO. Michael eventually remarried a woman named Chloe in 2024. In 2026, Michael tragically passes away in a car accident. He had over $1 million in his 401k. Chloe assumes she will receive the funds as his surviving spouse. However, Michael never updated his beneficiary form with his employer. Jennifer is still listed as the primary beneficiary. Under ERISA, the plan administrator is legally obligated to cut a check for $1 million to Jennifer, the ex-wife. Chloe is left with nothing, and because of federal preemption, she may have no legal recourse in state court to claw those funds back. This is why every deep dive checklist for a coastal divorce must include a mandatory, verified update of all ERISA-governed beneficiary designations the day the QDRO is executed. We also need to consider the 2026 implications of 401k fees and administrative costs during the division process. In many high-end corporate plans, the cost of reviewing and processing a QDRO is not absorbed by the company. It is charged directly to the participant's account. These fees can range from $500 to $3,000 per order. In a complex divorce where multiple accounts are being split, these administrative costs add up. A strategic settlement agreement must specify who bears these costs. If you are the alternate payee, you want to ensure the fee is deducted from the participant's remaining share, not from your awarded portion. Conversely, the participant must ensure that the QDRO language does not allow the plan to take the fee out of their segregated balance after the split. Furthermore, we are seeing a trend in 2026 where plan administrators are becoming more aggressive about forced distributions of small accounts. If the portion awarded to an ex-spouse is below a certain threshold, often $5,000 to $10,000, the plan may reserve the right to simply cut a check and kick the money out of the plan rather than setting up a separate account for the alternate payee. This triggers an immediate tax event for the receiver. If you are expecting a small slice of a 401k to stay invested, you might be surprised by a 1099-R and a tax bill you didn't plan for. The complexity of these accounts is compounded when we look at the specific 2026 landscape of the gig economy and the rise of the fractional executive. Many professionals in coastal cities now have 4 or 5 different 401k accounts from various short-term roles. The cost of drafting 5 separate QDROs can be astronomical. The strategy here often involves a consolidation phase, rolling the smaller, older 401ks into a single IRA before the divorce is finalized, allowing for a much simpler and cheaper division of one master account. However, this must be done before the legal separation date to avoid accusations of asset moving or commingling. We have now covered the risks of marital waste, the federal traps of beneficiary designations, and the administrative grit that can slow down a transfer. You have a masterclass level understanding of the mechanics. But there is one final, overarching shadow that looms over every 401k in 2026. The looming threat of legislative change and the potential for new tax brackets to be applied retroactively to your 401k distribution. As we look toward the final stages of our deep dive, we must analyze the volatility of the U.S. tax code itself and how a delay of just 30 days in your divorce filing could cost you 6 figures in future purchasing power due to shifting federal policy. The clock is not just a psychological pressure. It is a mathematical variable that is currently moving against you. The mathematical variable of time is particularly aggressive in 2026 due to the sunsetting of various provisions from previous tax reform acts. For those living in high-tax coastal hubs like Seattle or San Francisco, the delta between a 401k distribution taken in 2026 versus one taken in 2027 could be the difference between maintaining your lifestyle and a significant downward shift in your standard of living. In the United States, 401k assets are essentially a deferred tax liability. When you divide these assets during a divorce, you are not just dividing current value. You are dividing a future tax burden that is subject to the whims of a changing Congress. Imagine a case study involving a character named Robert, a senior project manager at a biotech firm in Boston. Robert and his spouse are negotiating the division of a $2,401,000. It is currently October of 2026. Robert's legal team is pushing to finalize the QDRO before the end of the calendar year. Why the rush? Because historical trends suggest that tax brackets for high earners are projected to shift upward in the coming fiscal cycle. If the QDRO is delayed and the distribution occurs in a year with higher marginal rates, the net after-tax value of the retirement account drops. For a coastal professional in the top bracket, A 4% increase in the effective tax rate on a $1 million share is a $40,000 loss in pure purchasing power. Robert understands that in 2026, the speed of your legal team is a direct component of your investment return. This brings us to the critical concept of the valuation date. In a volatile 2026 market, the date the court chooses to value the 401k is everything. Is it the date of the physical separation? The date the divorce petition was filed? Or the date of the actual trial? In coastal cities where high-beta tech stocks often dominate 401k portfolios, a 3-month delay in the valuation date can result in a 6-figure swing in the account's paper value. Consider a scenario where a couple separates in January 2026 when the Nasdaq is at an all-time high. By the time they reach a settlement in July, the market has corrected by 15%. If the court uses the January valuation date, the account holder is forced to pay out a percentage based on a peak value that no longer exists. They are essentially overpaying their spouse using deflated dollars. To mitigate this, sophisticated 2026 settlement agreements utilize a market-adjusted valuation clause. This clause ensures that the amount transferred to the alternate payee fluctuates in direct proportion to the actual performance of the underlying investments between the date of agreement and the date of transfer. Without this clause, you are gambling on the stability of the global economy during the most unstable period of your life. Furthermore, we must address the 2026 landscape of the net unrealized appreciation, or NUA strategy within a 401k. This is a highly specific maneuver for professionals who hold significant amounts of their employer's actual company stock inside their retirement plan. In coastal cities where firms like Apple, Google, or Nvidia dominate employment, many 401ks are heavily weighted in highly appreciated company shares. Normally, when you take a distribution from a 401k, it is taxed as ordinary income. However, if you utilize the NUA strategy during a QDRO distribution, you can potentially move that company stock into a taxable brokerage account. You pay ordinary income tax only on the original cost basis of the stock, while the massive growth, the appreciation, is taxed at the much lower long-term capital gains rate. Let us look at a character named Sarah, an early employee at a cloud computing firm in San Jose. Her 401k contains $500,000 worth of company stock that she acquired years ago for $50,000. In her 2026 divorce, she is awarded this stock through a QDRO. If her advisor is unaware of NUA, she might roll it into an IRA, eventually paying up to 37% federal tax on the entire balance. By utilizing NUA, she pays the high rate only on the $50,000 basis and locks in a 20% rate on the $450,000 gain. This move alone saves her nearly $80,000 in future tax leakage. In the 2026 coastal economy, failing to identify NUA opportunities is a form of professional negligence. Now we must transition to the psychological and tactical warfare of the 401k loan as a settlement leverage tool. We previously discussed the risks of these loans, but in 2026, we see them being used offensively. A spouse might intentionally take a maximum loan against their 401k immediately prior to filing for divorce to create an artificial debt that they then demand the marital estate cover. Or they might use the loan to pay for an aggressive legal retainer, effectively forcing their spouse to fund the very litigation being used against them. Imagine a character named Kevin in Los Angeles. Knowing a divorce is imminent, Kevin takes a $50,000 loan from his 401k and places the cash in a separate, undisclosed account. On his financial disclosure, the 401k balance is now $50,000 lower, and he lists a $50,000 liability. If his spouse's legal team is not diligent in 2026 forensic discovery, they might accept the lower valuation at face value. A masterclass level defense involves a look-back period of at least 24 months on all retirement account transactions to identify any sudden, non-routine loan activity. If found, the court can add that $50,000 back into the marital pot as a prepayment to Kevin, ensuring the other spouse is not cheated out of their half of the original value. The 2026 divorce process also requires an understanding of the 401k's role in calculating alimony and child support. Many coastal professionals assume that because a 401k is a retirement asset, it cannot be used to determine monthly support obligations. This is a historical inaccuracy. In many jurisdictions, once a 401k is divided and an alternate payee takes a distribution, that distribution can be counted as income for the purposes of modifying support. Even more dangerously, the potential income that could be generated by a large retirement account, even if not currently being withdrawn, is sometimes imputed to a spouse by the court. If you receive a $2,401,000 share, a judge in 2026 might decide you have the ability to generate $80,000 a year in passive income, thereby reducing the amount of alimony your ex-spouse is required to pay you. We have now explored the aggressive timeline of 2026 tax policy, the surgical precision of NUA strategies, and the offensive use of loans in the lead-up to a filing. You are seeing that the 401k is not just a passive fund. It is a dynamic weapon in the divorce theater. But there is one final piece of the puzzle that almost everyone forgets until it is too late. It is the administrative closure. After the QDRO is signed, after the taxes are calculated, and after the funds are moved, there is a period of extreme vulnerability where your data and your identity are at their highest risk. As we move into the final part of this deep dive, we will uncover the 2026 security protocols you must implement to ensure that your newly divided wealth actually stays in your pocket, and we will reveal the one post-divorce mistake that causes more 401k liquidations than any market crash in history. The final administrative phase of a coastal divorce is where the most disciplined professionals often stumble, falling victim to the exhaustion of a multi-year legal battle. In 2026, the digital security of your retirement assets is under constant threat, and the period immediately following the execution of a qualified domestic relations order is when your financial perimeter is at its most porous. The one post-divorce mistake that causes more 401k liquidations than any market crash is the failure to rollover combined with lifestyle inflation. It is a quiet, administrative oversight that triggers a cascade of taxes and penalties that can strip 40% of your awarded wealth in a single tax year. Imagine a character named Rachel, a marketing executive in Seattle. After 2 years of litigation, she finally receives her share of her ex-husband's 401k, a total of $400,000. The plan administrator sends her a packet of options. Exhausted by the process and feeling the financial squeeze of maintaining a Seattle lifestyle on a single income, Rachel hesitates. She doesn't immediately open a separate rollover IRA because she fails to provide instructions for a direct trustee-to-trustee transfer within the plan's designated window. The administrator eventually defaults to a direct distribution. They cut her a check for $320,000, having automatically withheld $80,000 for federal taxes. Rachel, seeing the large sum in her bank account, decides to use a portion of it to pay off her mounting legal fees and secure a down payment on a new condo to stabilize her life. By the time the next tax season arrives in 2027, Rachel realizes the magnitude of her error. Because the money was not rolled over into a qualified account within 60 days, the entire $400,000 is classified as ordinary income for 2026. This pushes her into a higher tax bracket, and because she is only 45 years old, she is hit with an additional 10% early withdrawal penalty. Her $400,000 award has effectively been reduced to $240,000 of actual utility. This is the historical trend of the liquidity trap. The psychological desire for a clean break and immediate stability in an expensive city often blinds individuals to the long-term mathematical reality of tax-deferred growth. To avoid this, the post-divorce protocol must be clinical. The moment the QDRO is approved by the plan administrator, the alternate payee must have a receiving IRA account fully established and ready to accept the transfer. This transfer should always be a direct rollover, where the funds move from the 401k custodian directly to the IRA custodian. The money should never touch your personal checking account. In the 2026 regulatory environment, the paperwork for these transfers has become increasingly digital, but the risk of wire fraud and phishing during the transfer window is at an all-time high. You must verify every transfer instruction via a known, secure phone line with your brokerage firm to ensure your settlement isn't intercepted by third-party bad actors. Furthermore, we must address the 2026 security reality for the participant's spouse. During a divorce, your former spouse likely had access to your passwords, your social security number, and the answers to your security questions. Even after the funds are divided, the participant's remaining 401k balance is vulnerable. Historical data shows a rise in unauthorized account access in high-conflict divorces. The absolute first step upon the finalization of the divorce is a total digital overhaul. This includes changing all passwords, enabling multi-factor authentication using a dedicated authenticator app rather than SMS, and specifically updating the security questions to answers that a former spouse could not possibly guess. If your security question is your first pet's name or your mother's maiden name, your ex-spouse already has the key to your vault. Now, let us examine the 2026 implications of the 401k catch-up provisions. For those over the age of 50, the IRS allows for significantly higher contribution limits. In a coastal city where your retirement timeline may have been pushed back by 5 or 10 years due to the cost of the divorce, maximizing these catch-up contributions is the primary strategy for rebuilding. Imagine a character named David in San Diego. At 55, his 401k was halved. To recover, he restructures his entire budget to hit the maximum 2026 contribution limit, plus the catch-up amount. He coordinates this with his employer's match, effectively utilizing his company's capital to accelerate his recovery. However, David must be careful. If his alimony or child support payments are calculated based on his gross income, he must ensure that his increased 401k contributions are not viewed by the court as a voluntary reduction of income to avoid support obligations. In 2026, some courts are increasingly looking at a participant's total savings rate as a factor in determining their ability to pay support. There is also the matter of the QDRO record keeping. Most people receive their finalized QDRO, see the money move, and then lose the document. This is a critical mistake. In 2026, with the frequent mergers of financial institutions and the migration of digital records, you may need that physical, court-certified QDRO 20 years from now when you finally retire. If the IRS questions the cost basis of your account or if a plan administrator claims you were already paid, the QDRO is your only legal shield. You must maintain a digital and physical copy of the certified order, the transmittal letter from the plan administrator, and the final statement showing the transfer was completed. As we conclude this masterclass, we must look at the broader perspective of the 2026 coastal professional. A divorce is a structural reset. While the division of a 401k feels like a loss, it is also the moment where you gain total autonomy over your financial destiny. You are no longer managing a compromise, you are managing a solo portfolio. This is the time to reevaluate your asset allocation. For many, the 401k was historically invested based on a joint risk tolerance. Now, your risk tolerance may be completely different. If you are the younger spouse with a longer time horizon, you might shift toward a more aggressive growth posture. If you are closer to retirement, you might prioritize capital preservation. The strategies we have deconstructed, from the tax landmines of NUA and the phantom debt of loans to the forensic tracing of premarital assets and the digital security of the final transfer, are the pillars of a successful financial transition. The potential outcomes of a 401k division are entirely dependent on the precision of your execution. Those who treat the 401k as a simple line item on a spreadsheet often find themselves decades behind their retirement goals. Those who treat it as a complex, multi-layered legal and financial instrument are the ones who successfully navigate the coastal divorce and emerge with their wealth and their future intact. You have now completed the deep dive masterclass on 401k divorce in U.S. coastal cities. You have the technical knowledge that even most attorneys lack. You understand the hidden tax codes, the corporate bureaucracies, and the psychological traps. But knowledge without action is just trivia. The next step is the implementation. How do you take this data and actually use it in a room full of litigators? How do you transform these concepts into a binding legal strategy that protects every dollar you have earned? The answers lie in the specific, high-stakes negotiation tactics used by the elite 1% of coastal professionals to settle their cases without ever stepping foot in a courtroom. We are only just beginning to peel back the curtain on the art of the high net worth settlement.